Hey there, everyone. This is Trent, the retirement planning coach, and welcome to this video. On this video, I am going to walk you through how to do some tax planning within NewRetirement, and some areas that I'm going to cover are yearly tax estimates to understand what your tax bill will potentially be over year for a long period of time. It is a little bit of guessing because you don't know what your income is exactly going to be, or what the tax rates are going to be, and other variables. But we can give you a good idea on what you might want to expect as far as an estimate for your taxes. How to compare the tax differences in multiple scenarios within NewRetirement, Roth conversions, and how Roth conversions can benefit you potentially, and how to determine how that conversion tax will impact you in the short term. It's really appealing to focus on the lifetime tax savings, but you need to understand that in order for the Roth conversion to be optimal, you need to afford the tax payments outside of the conversion event today, in order to make that work for you over a long period of time, which some people can't afford the tax bill that comes with the Roth conversions. And then lastly, the turnover ratio, or the tax drag on your taxable investment accounts, and how choosing tax efficient funds can help you over a long period of time. Less buying and selling within a portfolio is typically optimal from a tax perspective. So those are the four areas that I'm going to cover in this video. If you're new here, I produce content and videos for do-it-yourself investors and fee-conscious investors, more specifically, who want free help in education on YouTube, and then also in the Retirement Planning Club, which the link is in the description, or you can go to secureyourretirementnow.com, and that club is made up of 230 some members who are wanting to learn how to build their own retirement plan, not alone, but with some guidance and from an expert like myself, to make sure that they aren't missing anything. So if you want a support system in a community that you can plug into very easily and start conversations and collaborate with like-minded pre-retirees and retirees, join the Retirement Planning Club. We would be more than happy to welcome you. By the way, within the Retirement Planning Club is a free DIY retirement planning course where I show you from start to finish how to build your own retirement plan using NewRetirement and other financial tools that you can leverage on your own terms. So yearly tax estimates. This is an area within NewRetirement. Let me just go to the baseline plan. If you're not familiar with NewRetirement, I have many videos within the Retirement Planning Club. But NewRetirement is a great planning software program. My guess is you are somewhat familiar with it, so I'm not going to go into the background of it. So if you go to NewRetirement and you go to the Insights area, you'll see taxes in the menu, and then you'll go to the estimated taxes over your lifetime. So total in this scenario, for this hypothetical situation, total taxes 1.7 million from 2022 through 2049, which is obviously a lot of money going to taxes. But it'll show you a breakdown of year over year what you can expect to pay in taxes, and whether that's federal, state, FICA, capital gains. It'll break it down for you. Again, these are estimates. Nobody knows exactly what they're going to be. But when you're thinking about tax planning for the next year, as long as your information is plugged into the system accurately, and that information is like actually what's going on in your life, then it should be pretty close within some parameters. The biggest parameter or factor, I should say, that will influence the difference is what happens in your portfolio, what happens exactly for your income, and whether you do maybe Roth conversions or not. But if you're a or if you're a business owner and your compensation is very like variable and can vary year over year, that can be tough unless you pay yourself a fixed salary. But anyway, I'm not going to get into that. You can see year over year what your estimated taxes will be over the course of your retirement, which is very useful to understanding cash flow in retirement. You can go and see the chart where it's gross taxable income by source, federal tax deductions, and even net taxable income by federal tax bracket. And this is very interesting to see how much of your income is taxed at which bracket, which can give you, like, as you can see, there's some years here without income. This makes potentially a whole lot of sense for doing some Roth conversions. And so this is where you can understand what your potential taxes will be on an annual basis based on the facts as they stand today. You can also run this based on hypothetical situations and scenarios such as, let's just say, Roth conversions. All right. So let me go to Roth conversions. I already built a scenario that is converting assets in pretty significant chunks, which I'll show you after going through the same kind of chart. So you can see, let me just toggle. This will be helpful if I toggle back and forth. I wish they would do an overlay. I wish NewRetirement would do an overlay based on the previous scenario that you had in here, so you could see the difference right on, like, kind of like before and after in the same chart. That would be pretty cool. But a workaround is just to have two screens and just flip flop back and forth. So you can see here the estimated taxes for the baseline plan. Pretty low over this period of time from 2026 through 2031. And the Roth conversions, you can see that leveled out. And the reason for it leveling out is because it is reduced on the back end, right? So paying a little bit more taxes sooner for the benefit of saving taxes in the long term. Okay, so same charts are available every time you make a new scenario. You can go through and figure out how your tax dollars are being allocated based on all of these charts that I showed you previously. So you can flip-flop very quickly between scenarios to run these same charts. You can switch between federal and state to show different information down here. Another thing that you can, that's beneficial in my opinion, is to go to the accounts and assets or any of the tabs within my plan. And as you toggle between scenarios, you will see the lifetime change in estate value and the lifetime change in taxes over time. So if you go from the baseline to the Roth conversion schedule that I built in, you can see that there's a decent savings in lifetime taxes, $122K and $300K of potential higher estate value, right? So what this tells me is that the Roth conversion schedule that I plugged in to the system could be beneficial for this situation, right? And by following a conversion schedule, like I'll show you in just a second, again, this is hypothetical. This is just showing you how to take advantage of the lower tax years, can benefit you over a long period of time, and then showing you how to dive into the year over year, which is what I just showed you, to see what you will owe additionally in taxes by triggering a Roth or executing on a Roth conversion. So this is really helpful if you didn't know this about NewRetirement. By toggling between plans, it'll show you the difference in taxes and estate value based off of the factors that you changed within the scenarios. As far as the Roth conversion scenario that I built for this specific, again, this is like not relevant to you, but where you go to do Roth conversion planning is in the, the move money area. I just had a brain fart. So what you can do is go to the money flows under my plan, and then you can list out a conversion schedule, whatever you want to test to see if it is beneficial to you. So this is the conversion schedule that I did for this scenario, 70K, 70K, 90K, and then back to 50K. So ending in 2031, which if you go back to the baseline plan, and then if you go to the taxes, I'm just stumbling around today, taxes. So yeah, this is just taking advantage of this window, of this Roth conversion window that you see here. All right. So essentially processing Roth conversions from 2025 to 2031 to take advantage of the lower income years and filling that with Roth conversions. There's plenty of assets to pay for the taxes on the conversion based off of this, again, very hypothetical situation. This is not relevant to you. If you want to see what the consequences are or the tax burden of a Roth conversion, literally all you need to do is just either toggle between the baseline and the Roth conversion scenario and just see what the difference is by hovering over the bar or the year, and then going over to the right-hand side to see what the difference is for that specific year. So you can I can't show you both at the same time. I can't move my cursor from here to there, but you can see as they change on this right-hand box area, the values change if you hover over each of the individual years. So that's why I like having duplicates up, so I can say, oh, for 2026, or yeah, let's just do 2026. Here's my total tax bill for 2026 if I do Roth conversions. So that is almost 10 grand. Roth conversions, that same 2026 is going to be about $28,000. So that means I have to come up with an additional, call it $19,000 to $20,000 of additional available liquidity to afford that Roth conversion event in 2026 is how you can think about it. Right. And so you need to have that liquidity to pay for the Roth conversion taxes on the Roth conversion event. Okay. So that's how you get the estimates on an annual basis. That's how you compare and kind of toggling back and forth between the scenarios to see the differences in either lifetime taxes or the year-over-year taxes. Specifically for Roth conversions, if you just flip-flop between, you can, do it that way. Or what you can do is just simply take an Excel spreadsheet and just list out the different tax amounts year over year for one scenario, and then you can have a column next to it for the other scenario, so you can see side by side, year over year, the differences in taxes for each situation that you want to compare. One other area that isn't talked enough about, I don't think, I really haven't talked about it too much on YouTube, is the turnover ratio for the funds that you own, or the tax drag on the funds that you are exposed to within your taxable investment accounts, right? Retirement accounts, irrelevant, taxable investment accounts. So just to kind of show you the difference in the turnover rates and how that can impact you from a tax position and a state value position. If you go over to the My Plan accounts and assets, you go to your taxable investment account. So this is only relevant to viewers who have taxable investment accounts that are significant of value. So if you have an account that's $10,000 of taxable, like a taxable portfolio, it's really probably not going to make a huge difference over a long period of time unless you have large contributions to that account for many years. Then it could really make a big difference. But if you're just holding 10K for 20 years, it doesn't matter if it's a 5% turnover rate or a 20% turnover rate, it's really not going to make that big of a difference probably in the big picture. But if you have a significant, and again, significant means different things to different people, but let's just say you have $1 million taxable investment portfolio, and the turnover rate is 5%. So 5% turnover rate compared to the 20 could result in $500 to $600,000 more at longevity, or at 90 in this scenario, or potentially paying $64,000 less in taxes. And so this is owning, just to kind of give you an idea of what this means. Like if you own an actively managed mutual fund where there's a lot of buying and selling of securities within it, and a lot of people like this year, are losing money on their funds, but they're going to have some capital gains owed. And people are probably thinking, why would I owe money on a fund when I lost money this year? Well, that's carried forward from previous years that had a lot of run up in their the value and the cost basis of the securities that they own within the fund. So that's the reasoning. But if you take more of a index approach or a passive approach with the stocks that you own, you can just buy and hold quality securities. Again, this is not financial advice or investment advice, but this is just explaining the benefits of tax efficient strategies versus not so tax efficient strategies. So if there's a lot of buying and selling of securities, you could experience larger turnover, right? And that results in higher capital gains on an ongoing basis. If you have a low turnover or less buying and selling of securities within a investment strategy, such as an index fund like the S&P 500, as long as you're not buying and selling that fund, you shouldn't owe any capital gains. So that's much more tax efficient than a actively managed fund that is buying and selling dozens of times over the course of a year. And so the difference between having a low turnover ratio and a high turnover ratio can add significant drag to your portfolio if it's higher, right? And so 20% is not anything crazy. I've seen turnover ratios of 50% for funds. I've seen even higher than that, where literally the fund is buying and selling like very often within their fund. So if you have something like you go from 5% and you have a 35% turnover rate, you could have $800K less in your estate value and pay $80,000 more in lifetime taxes. So you get what I'm saying. You need to, when it comes to tax planning, focus on the yearly estimates, Roth conversions, comparing the differences in the timing of retirement, how you take your pension, how you take Social Security, whether you do Roth conversions, and how you invest in taxable accounts can make a big difference when you combine all of these things together. It definitely can make a significant difference to your situation, over a long period of time. Individually, sometimes it might be negligible. You might say, really, it's not worth saving, this amount of money in lifetime taxes, depending on your situation. So in a nutshell, this is how you use NewRetirement from, I would say, a high level to like a little bit more granular on how to make some tweaks and changes. So this is how you do some basic tax planning and estimating based on when you want to retire, Roth conversions, how you invest, how much you're spending, and all of the different factors that come with planning for retirement. I hope this was somewhat helpful. If it was, give me a like, comment below. If you like NewRetirement and if you've been using it, if you need support and help, remember, just go to secureyourretirementnow.com and I can give you access to the Retirement Planning Club. It's free and there's 230 plus members. You can take a free course and there's a great forum where the members and myself are collaborating and engaging with each other in discussions about everything I mentioned today and a lot more. All right. So again, secureyourretirementnow.com. That's it for this video. I will see you on the next one. Take care. Bye.